Ever stop to think about what makes a massive company like Hindustan Unilever tick? I mean, how do they actually manage to sell so much stuff we use every day, and how do they plan for what's next?
Right. It's fascinating when you look under the hood.
So today we're going to try and, pull back the curtain a bit. We'll dive deep into their latest financial report and what their leadership actually had to say about it all.
Exactly. We've got the official announcement, the one covering their financial results for the year ending March 31st, 2025. And we also have the transcript from their earnings call with analysts.
Ah, the earnings call. Always some good details in there.
Definitely. It's a real treasure trove of information, straight from the horse's mouth.
So our goal for you today is pretty simple. Help you understand how HUL performed over the past year, what key strategic moves they're making, and what they expect in the near future.
And crucially, without getting totally bogged down in endless numbers and jargon.
Yeah, think of it like the Cliffs Notes version, but hopefully with all the juicy bits included.
And it's important to remember, like you said, we're sticking strictly to what HUL themselves have reported and discussed. This is all from their official documents.
No outside speculation, just what they said.
Precisely. A close look at their own view of their business.
All right, then let's jump right in. The big question. How did HUL actually do in the last financial year? What's the headline?
Well, the big picture, I'd say, is one of steady progress. Their turnover reached 60,680 crores. That's RS year RS. 60,680 crores.
Okay, 60,680 crores. How does that compare?
It's up about 2% compared to the year before, which was RS 59,579 crores. And their profit before tax also saw a rise. It went up to RS 14,300 crores from RS 13,675 crores.
So 2% growth on the top line. Sounds like they're, keeping the ship moving in the right direction. What about expenses? We always hear about raw material costs.
That's a really interesting point, actually. Their net material inflation, or NMI, which basically tracks the overall cost of their raw materials, it actually remained flat for the year.
Flat, really, with everything going on.
Yeah, it's quite fascinating. They managed the sort of balancing act. They saw price hikes in things like palm oil, tea, and coffee, but those were offset by price drops in other areas: crude oil, soda ash, skimmed milk powder, that kind of thing. Plus, they found some efficiencies in how they buy things.
Ah, okay. So like one hand goes up, the other goes down, and it evens out. Makes sense. Now, how did all that translate into actual sales? The stuff leaving the shelves.
So their underlying sales growth was also 2%. And what's really notable here is that this growth came entirely from selling more stuff. Their underlying volume growth was also 2%.
Wait, so pricing growth was basically zero?
Pretty much near zero for the year, yeah. They weren't really pushing up prices overall.
Huh. So despite that slight overall growth, it's clear they aren't relying on price hikes. Suggests a pretty competitive market, doesn't it? Where volume is maybe the main game.
It certainly seems that way. Maintaining or gaining share through volume looks like the priority.
Okay, so what about profitability then? Margins. Did they manage to hold on to their earnings?
Right, so gross margin, that's the profit directly from selling products. Before operating expenses, it saw a slight dip, down 50 basis points year on year, ending up at 50.3%.
50 basis points.
Yeah.
So 0.5%.
Exactly. And HUL said this dip was mainly due to the mix of products they sold and also because they ramped up investments in distribution, getting products out there.
Okay, and their operating profit, EBITDA.
Their EBITDA margin earnings before interest, taxes, depreciation, and amortization, yeah, that stayed healthy at 23.6%, but it was also slightly lower, down 30 basis points compared to the previous year.
So a bit of pressure on those direct profits, probably because they're spending more to, like you said, get products out there or maybe promote them.
Seems likely, yes. Strategic spending impacting those margins slightly.
And what about the final profit number, the bottom line, profit after tax?
Overall, their profit after tax, the PAT, showed a 5% increase, but there is a catch. That includes a one-time gain they got from selling off their Purite water purification business. If you take that exceptional item out, the underlying growth in PAPI was actually 1%.
Right. Okay. So that sale gave the headline number a bit of a boost. Good to know. Now, one thing lots of investors watch closely is dividends. How much cash shareholders get back? What did HUL announce there?
They declared a total dividend of Rs 53 per share for the year. That's made up of a final dividend of Rs 24 plus an interim one they already paid out of Rs 19.
Okay.
And a special dividend of Rs 10.
A special dividend too. Interesting.
Yeah, and what's significant is that this total dividend, the Rs 53, is a hefty 26% increase compared to the previous year, mainly because of that special dividend, of course.
Wow, 26% increase in the total payout. It's a pretty good return for investors, right?
Definitely signals confidence, or at least a commitment to returning cash.
So putting it all together for the year, we see modest growth, maybe 2%, a little bit of pressure on immediate profit margins, likely due to strategic spending and investments, but a healthy payout to shareholders, boosted by that special dividend.
That sums up the overall picture quite well, yes.
Okay, now let's zoom in a bit. HUL has quite diverse businesses. How did the different parts perform? Let's break it down by segment.
Absolutely. Let's start with home care. That's things like detergents, household
Right.
cleaners.
Surf Excel, Domex, that sort of thing.
Exactly. This segment had really strong growth in volume, the number of items they sold, high single digits. And their overall sales in this area, the underlying sales growth, was 5%.
Okay, high single-digit volume growth, but only 5% sales growth. Why the difference?
Good question. They said it's because they actually passed on some of the savings from lower raw material costs back to consumers. So prices came down a bit in some areas.
So they lowered prices, driving volume, but moderating the sales value growth. Interesting strategy.
Yeah.
And the profit margin in home care.
Pretty healthy at 19%. And they specifically called out really strong double-digit growth in their liquid products within home care.
Liquids seem to be a big focus everywhere. So home care is cleaning up, you could say, especially those liquids. How did beauty and well-being do? Skin care, hair care, Pond's, Lakme, Dove.
Beauty and well-being saw a 2% increase in underlying sales. And again, this was driven by selling more products, so volume-led. Hair care had a particularly good year, strong growth there.
But I sense a but.
Well, their skincare products faced some challenges. They didn't specify exactly what, but performance was impacted there. Despite that, though, the overall segment still had a very healthy profit margin of 32%.
32% margin. Wow. So a bit of a mixed bag in beauty and well-being. Hair doing great, skin facing some bumps, but very profitable overall. Let's move to personal care. Soaps, oral hygiene, Life Buoy, Pepsodent.
Right. Personal care actually saw a 3% decrease in underlying sales, and they sold slightly fewer products as well, a low single-digit decline in underlying volume.
Oh, top line there.
They mentioned it was partly due to their hygiene product lines, maybe less demand post-pandemic peak, and also the impact of commodity price transitions. The profit margin for personal care landed at 18%.
Okay, so personal care seems to have had a tougher year compared to the others. What about their foods division? Tea, coffee, Knorr, Horlicks.
The food segment, which includes nutrition drinks, tea, coffee, ice cream, packaged foods, had flat overall turnover. And they sold slightly fewer items, a low single-digit volume decline.
Flat turnover, volume decline. What dragged it down?
They pointed pretty clearly to their nutrition drinks, think Horlicks and Boost, as the main reason for the drag.
The nutrition drinks. That's been a challenging category for a while, hasn't it?
It has. But it wasn't all bad news in foods. They had good performance in coffee, ice cream performed well, and packaged foods did okay too. And their tea business, while maybe facing market pressures, maintained its market leadership position. The profit margin for the food segment overall was 18%.
Okay, so some definite bright spots in foods, like coffee and ice cream. But nutrition drinks is clearly an area needing attention. Now, past results are one thing. What did HUL say about their plans? Their strategy going forward? Any big changes?
Yeah, this is where it gets really interesting, and you see where they're placing their bets for the future. They're using a new framework, a new way to look at their brands. They're categorizing them as core, future core, and market makers.
Core, future core, market makers. Okay, what's the idea behind that?
The basic idea is to manage their massive portfolio more strategically, to decide where to focus energy and investment and tailor the approach for each type of brand.
Makes sense. You wouldn't manage a huge established brand like, say, Surf Excel the same way you'd manage a newer niche product. Tell me more about these categories.
Sure. Core brands are pretty much what you'd expect, the big, iconic, mass market ones that are central to their business today. Think Life Buoy, Surf Excel, Glow and Lovely in that bucket.
Right, the household names.
Then you have future core. These are brands, often in more premium spaces, that they want to grow faster than the market, reach more consumers, and really build for the future. Pond's seems to be a key example here.
Okay, becoming more premium, faster growth, and market makers.
Market makers are all about creating new markets, new demand spaces, often leveraging digital channels or new technologies. They're probably a smaller part of the business now, but hold the potential for really rapid, maybe even disruptive growth. Think about minimalist, maybe, or some of their newer wellness propositions.
Okay, core, future core, market makers. A clear way to segment things. What specific actions are they taking within these categories? Any examples?
Definitely. They've been actively working on their core brands. They highlighted relaunching two major ones, Lifebuoy and Glow and Lovely.
Relaunching Lifebuoy, it feels like it's been around forever.
It has, but they revamped it with something called Stratos technology. The idea is to move beyond just germ kill to offering more advanced skin protection benefits as well. They also leverage big events like the Kumbh Mela and the IPL cricket tournament, using celebrity endorsements to really push that new message.
Interesting pivot for Lifebuoy.
And Glow and Lovely.
That also got a refresh, a new proposition focused on newer, brighter skin every day, updated packaging, and a very digital-first media strategy. They did also acknowledge, though, that they need to improve performance in nutrition drinks, which fall under the core umbrella, too.
Right, the nutrition challenge again. It sounds like they're putting serious effort into keeping those massive core brands relevant and strong. What about the other two categories? Future core and market makers.
This is really where the growth engine is shifting. They reported that Future Core delivered competitive growth and market makers delivered double-digit growth. Combined, this actually led to a 200 basis point shift in their overall portfolio mix away from the core brands just in the past year. Wow, 200 basis points. So 2% of the whole business shifted mix in 1 year. That's quite significant.
It is, and their big goal, their ambition, is for over 80% of their future growth delta, the incremental growth to come from these future core and market maker segments in the medium to long term.
80%, that's a huge strategic bet.
It really is. Pond's is a great example they gave of this transformation in action. They've elevated the brand, made it more premium. They revamped about 2/3 of its products that fall into future core and market maker categories. And they're focusing heavily on selling through specialized channels. They got modern trade, beauty advisors, online, and using digital media. This is leading to much higher growth in what they call the channels of the future.
That Pond's example really illustrates the shift. It sounds like future core and market makers are absolutely key to their future plans.
Right.
What other big strategic moves did they highlight?
Their home care liquid strategy is another big one. We saw the growth earlier. They're accelerating that transformation with product upgrades for better functionality, expanding into tier 2 cities, moving into adjacent spaces like fabric conditioners maybe, and also premiumizing parts of the range. That's driving that strong double-digit growth.
Okay, liquids are definitely a focus. Anything else on the strategy front?
Yeah, they talked about their Excel pillar of their strategy. This has a few parts. One is building unmissably superior brands. They're aiming for over 80% of their portfolio to be demonstrably better than competitors.
80% superior, that's a high bar.
It is. Another part is accelerating digital media investments. They mentioned a 40% increase in influencer spending specifically. And the third part is enhancing execution and design for different channel capabilities, things like improving online availability, better on-shelf presentation in stores, and even doubling the range of products available through quick commerce platforms.
Influencer spending up 40%. Wow, they're really leaning into digital and quick commerce too.
Absolutely. They also mentioned a specific strategy called Win with WAMI 2.0.
Why am I?
It stands for Winning in Many Indices. WAMI 2.0 is focused on targeting affluent consumer clusters, especially in cities, and also specialized channels like health and wellness stores, premium beauty outlets, gourmet food stores, reaching specific high-value consumer groups.
Targeting the premium end more deliberately. Makes sense with the portfolio shift. What about the nuts and bolts? Supply chain, distribution.
On the supply chain side, the focus is on making it leaner, more digital, more autonomous. They actually highlighted their Duma factory in Assam, which received recognition from the World Economic Forum for its advancements in technology and sustainability.
Recognition from the WEF. That's pretty impressive for a factory.
It really is. It speaks volumes about their operational focus. And for traditional trade, the small Kirana stores, which are so vital in India, they have a model they describe as Kirana-centric and distributor-inclusive. They've significantly increased their direct reach, now covering 69% of stores by value, which they said is a 400 basis point increase in just 18 months.
Wow, reaching more stores directly. That must involve significant investment too.
No doubt. And behind the scenes, they're leveraging AI, data, and analytics across their whole value chain to find savings. They quantified this at about 3.5% of their turnover, which is substantial. On a more structural note, they've also streamlined the business organizationally into 4 main integrated business units.
Okay, lots of initiatives, moving parts. Were there any major acquisitions or significant new product launches we should know about?
Yes, definitely 2 big ones to mention. First, they completed the acquisition of a 90.5% stake in Uprising Science Private Limited. That's the company behind the minimalist skincare brand.
Ah, Minimalist. That's a very popular digital-first brand, isn't it?
Exactly. The deal was completed on April 21st, 2025, so just after the end of this financial year we're discussing. The cost was significant Rs, 2,706 crores. So it won't impact these FY25 results, but it's a major strategic move.
Over 2,700 cores for Minimalist. That really signals a serious push into that premium digital beauty space.
Very interesting. What was the other one? They also introduced Liquid IV into the Indian market. That's a well-known global Unilever brand in the hydration and well-being space, so bringing a global power brand into their Indian well-being portfolio.
Liquid IV.
Mm.
Okay. Adding to the wellness side. Got it. Now, let's maybe shift focus slightly to just the last quarter, the March quarter of 2025. Were there any key differences in performance compared to the full year trends?
Yeah, looking just at Q4 FY25, their underlying sales growth was a bit higher than the full year, coming in at 3%. This was driven by 2% underlying volume growth, so slightly better momentum perhaps at the end of the year.
Okay, 3% sales growth, 2% volume growth. What about pricing in that quarter?
They had some calibrated price increases, specifically in skin cleansing and beverages, but these were offset by price reductions in home care, continuing that trend we discussed earlier.
Right, passing deflation back in home care and margins in Q4.
Gross margin in Q4 was lower compared to the same quarter last year. It came in at 49.8%, which was down 160 basis points year on year.
160 BPS. That's a bigger dip than the full year.
What? They said it was mainly because commodity inflation in things like palm oil, tea, and coffee hadn't been fully priced through to consumers yet. So costs went up, but prices hadn't fully caught up in that specific period. Their EBITDA margin was also slightly lower year on year in Q4 at 23.1%, down 30 basis points.
Okay, so continued margin pressure in the last quarter, maybe even a bit more pronounced on the gross margin line due to that lag in pricing versus costs and profit after tax for the quarter.
PIT, both before and after exceptional items, grew by 4% in the quarter. They mentioned this got a bit of a boost from some interest income they received related to a tax adjustment from a prior period.
Okay, so Q4, slightly better sales momentum, but continued, maybe even slightly increased, pressure on gross margins due to that commodity cost timing. How did the segments perform specifically in those 3 months?
Home care continued its strong run, mid-single-digit underlying volume growth overall. Fabric wash saw high single-digit growth, and household care liquids were again the star with double-digit volume growth. They even said their liquids portfolio grew 5 times faster than the rest of home care in terms of volume.
5 times faster. That liquid strategy is really paying off. What about beauty and well-being in Q4?
That segment had 3% underlying sales growth. Hair care continued its double-digit growth streak. However, skincare and color cosmetics, especially in the mass parts of the market, saw a low single-digit decline.
Still some softness in mass skin and color cosmetics then. Any bright spots?
Yes, they mentioned Glow and Lovely showed some sequential improvement compared to the previous quarter, which is positive. And growth through their channels of the future was very strong, particularly e-commerce, which saw around 40% growth in gross sales value. They also launched new products under Lakme, Hya Matte, and Pond's Hydra Miracle extensions and strengthened their sun care range.
Okay, so beauty and well-being showing momentum in e-commerce and premium, still working on the mass side. What about personal care and foods in the March quarter?
Personal care saw 3% underlying sales growth in Q4, but they noted this was led by pricing, partly because it was compared against a soft base from the previous year. Underlying volumes were likely flat or slightly down.
So price-led growth in personal care for Q4. Any specific product areas?
Skin cleansing had low single-digit growth. Within that, their non-hygiene soaps did better, and body wash continued its strong double-digit growth. They also did the big Lifebuoy relaunch during that quarter. Oral care also had low single-digit growth, supported by the launch of a new Close-Up White Now toothpaste.
Okay, and foods in Q4.
Foods actually saw turnover decline by 1% in the quarter. There was low single-digit price growth, but that was more than offset by a volume decline.
Volume decline in foods again. Still the nutrition drinks issue.
Primarily, yes. They did say the sales trajectory for tea improved, which is good. They launched some new Puka herbal infusions. Coffee continued its double-digit growth, especially strong in future channels and with new formats. But yeah, nutrition drinks continued to decline, citing category headwinds and also the impact of changes they made to pack sizes and pricing architecture.
Right. What about the rest of foods?
Packaged foods saw mid-single-digit growth, which was volume-led, and ice cream had a strong quarter with double-digit volume-led growth, helped by new launches and a revamped strategy for their in-home business.
Ice cream doing well, that's good news heading into summer. But nutrition drinks definitely seems like a persistent challenge for them. What's their actual plan to try and turn that business around? Did they elaborate?
They did. They laid out a pretty detailed four-pronged strategy to tackle the issues with nutrition drinks.
Okay, let's hear it.
First, address the category headwinds and improve consumption by adjusting their pack price architecture, specifically reducing the price gap between the smaller sachets and the larger packs to encourage upgrades or trial.
Makes sense. Make the bigger packs seem like better value. What else?
Second, modernize the core Horlicks brand. Focus on its nutritional benefits, make it more relevant for today's consumers. Third, intensify their focus on specialist nutrition. This means raising awareness of specific health conditions where their products can help, improving the claims they make, and using targeted medical marketing to reach healthcare professionals.
So sharpening the health credentials and communication. And the fourth point.
Fourth, expand their other brand, Boost. Take it into new regions, potentially new formats like ready-to-drink options to broaden its reach.
Adjusting price packs, modernizing Horlicks, boosting specialist nutrition, expanding Boost. It sounds comprehensive.
Yeah.
But turning around a segment like that in a competitive market is tough.
It absolutely is. It'll be really interesting to see how those price adjustments and the brand modernization efforts actually play out with consumers.
Definitely one to watch. Okay, so that covers the recent performance and key strategies. Looking ahead now, what does HUL expect for the rest of this year, FY26, and the near future? What's the outlook?
They seem cautiously optimistic. They expect their growth trends to gradually improve.
Why? What are they banking on?
Two main things, really. One is the impact of all those portfolio transformation initiatives we just discussed finally kicking in. The other is an expectation that the overall macroeconomic conditions in India will get better.
What kind of macro improvements?
They mentioned potential benefits from things like monetary stimulus, maybe tax relief, lower inflation in food and crude oil, and hopefully a good monsoon leading to higher agricultural output, things that put more money in people's pockets or reduce cost pressures.
Okay, so a combination of internal actions and external tailwinds. Any sense of timing?
They specifically said they expect the first half of their next financial year, so April to September 2025, to be better than the second half of the year we've just been discussing, the period ending March 2025.
So expecting an improvement relatively soon, that's a positive signal. What about pricing and profit margins going forward?
They anticipate price growth will likely be in the low single digits. Kind of a mixed bag. Again, inflation in some areas like tea or coffee might push prices up, but deflation in others like crude-linked chemicals might allow for price reductions, assuming commodity prices remain relatively stable.
And the impact on margins?
They expect their gross margin to moderate a bit further, partly due to that commodity inflation pass-through lag we saw in Q4, and also because they're continuing to focus on providing good value to consumers. Plus, and this is key, they plan to step up investments.
Investing more in what?
Specifically behind those market-making platforms, the channels of the future like e-commerce and quick commerce, and building up their strategic capabilities, data analytics, digital marketing, etc.
So if gross margin moderates and they're spending more on A&P and capabilities, what does that mean for the EBITDA margin?
They guided that they expect their EBITDA margin to be maintained in the 22-23% range for the near term. This explicitly reflects those increased investments.
23%. That's a bit lower than the 23.6% they just reported for FY25, isn't it?
It is, yes. It signals a clear prioritization. For the next, say, 1 or 2 quarters, their main focus is driving growth first, with profitability being a secondary, though still important, concern.
So they're willing to accept slightly lower margins temporarily to invest in accelerating growth.
That seems to be exactly the strategy. However, they did reiterate that their long-term intention remains modest margin improvement. They expect margins could start improving again in the later part of FY26, maybe the second half, if commodity prices are stable and the growth picks up.
Okay, so a near-term investment phase, potentially followed by margin recovery later. Did they talk about operating leverage? Getting more efficient as they grow?
Yes, they did. They estimated that every 1% of delta growth, extra growth, should give them about 40 to 50 basis points of operating leverage benefit.
Right, so as sales go up, costs don't go up quite as fast.
Exactly. But here's the crucial part for the near term. They plan to reinvest that operating leverage benefit straight back into the business, more marketing, more capability building. They don't expect operating leverage to actually boost the bottom line profitability until they see a few quarters of sustained volume growth.
So efficiency gains get plowed back in initially, a very clear trade-off. Invest now for stronger growth later, with better profitability following that growth. Makes sense strategically.
Mm.
What specific areas will they be really concentrating on, and what potential challenges do they foresee?
Well, the main areas of focus internally seem to be really turning around the performance of those key brands we discussed, Life Buoy, Glow and Lovely, and especially those tricky nutrition drinks. Getting those back on a strong footing is critical.
And challenges.
Competition is always a factor. They acknowledge that in detergents, oral care, and they also hinted potentially in the growing sunscreen market. There's also the execution risk around those pack price changes in nutrition drinks. How will consumers actually react? Managing commodity price volatility remains a constant challenge. And fundamentally, it's about striking that right balance between investing for growth and maintaining healthy profitability in the short term.
Lots to juggle, definitely.
Yeah.
Now, you mentioned the earnings call transcript. Those Q&A sessions with analysts often bring out some extra nuggets, clarifications, or insights. Did anything interesting come up there?
Absolutely. The Q&A is often very revealing. For instance, they clarified that the temporary dip expected in the EBITDA margin guidance, that 22-23% range, isn't mainly about price cuts in home care. It's more about broad-based investments across the portfolio, but perhaps particularly dialed up in beauty and well-being.
Okay, so the investment push is maybe stronger in beauty and well-being.
That was the implication, yes. They also gave a bit more color on why the gross margin is moderating. It's a mix of factors. Those inflation-deflation price adjustments, investments they're making with their trade partners, like distributors, and also investments in improving product quality itself. They even gave an example of the increased costs associated with achieving that higher direct distribution reach. Getting products into more stores costs money.
Right, that wider reach isn't free. Did they sound confident about the future?
Very much so. They expressed a strong belief that the positive macro triggers they expect, combined with their own internal business improvements, will lead to stronger market demand. They framed their strategy as distinctly offensive, focused squarely on capturing growth opportunities.
Offensive strategy. Okay. What else from the Q&A?
On nutrition drinks, they really hammered home the point that margin isn't the core problem there. The absolute priority is driving consumption through those specific actions they outlined. Price packs, modernization, etc.
Get people buying it first, worry about margin later.
Essentially, yes. For sunscreen, they characterized it as a high-growth, potentially high-margin category, but with very low penetration in India currently. So their focus is all about consumer education and offering credible, effective products to build that market.
Makes sense for an emerging category like sunscreen. Did they give any more specific timing on when they expect demand to improve?
They did hint at expecting improvement in the next couple of quarters, specifically mentioning the June and September 2025 quarters as periods where they hope to see better demand materialize. And they reconfirmed that the 22-23% EBITDA margin guidance is for the near to midterm, maybe 2 to 3 quarters, and the long-term ambition for margin improvement definitely remains intact.
Okay, 2 to 3 quarters for that investment phase. Any more specifics on pricing plans?
They indicated that the price corrections in home care are largely done now. In fact, you might see slightly negative price growth in home care for the next quarter or two as those earlier deflation benefits fully flow through. However, in foods, specifically tea and coffee, and in personal care, specifically skin cleansing, they suggested there might still be some pricing actions needed to bridge gaps between their current prices and the higher commodity costs they're facing.
Okay, so maybe some price increases still to come in tea, coffee, and soaps.
Potentially, yes, depending on how costs evolve. They also talked about the skincare transformation. They expect the efforts there focusing on market makers, e-commerce growth, addressing the mass portfolio with the Glow and Lovely relaunch, and introducing products in new demand spaces to start showing a real impact in terms of revenue growth from Q3 of this financial year onwards. So maybe starting around the October-December 2025 period.
And just to confirm, that margin forecast doesn't assume they get more efficient in the next few quarters. Any operating leverage benefits?
Correct. The 22-23% guidance assumes any operating leverage gains in the next 2 or 3 quarters will be reinvested back into the business. They only expect that leverage to start contributing positively to the margin percentage in the second half of FY26, assuming volume growth improves as they anticipate.
Right. And their gross margin outlook, does that factor in current high commodity prices like palm oil?
Yes, their outlook is based on current commodity price levels. Interestingly, they mentioned they might still have some room to increase prices in skin cleansing and beauty and well-being if crude palm oil stays firm, because they apparently didn't price fully to the peak of the inflation when it spiked earlier.
Ah, so maybe some pricing power held in reserve there.
Perhaps. But they stressed again that the absolute focus right now is volume-led competitive growth. Selling more units is the name of the game. They also expressed optimism that personal care, which had a tougher year, is expected to come back strongly as the overall economy improves.
And those increased investments, are they spread evenly or targeted?
Definitely targeted. They explicitly said the step up in investments will be more focused on the future core and market makers portfolios, the segments that are already growing strongly and where they see the biggest future potential.
Makes strategic sense. Did they mention quick commerce? How big is that for them?
They did. Quick commerce, those super fast delivery platforms, is currently about 2% of their overall business. That's about a third of their total e-commerce sales. It's growing very fast, and they're using a differentiated, often more premium assortment of products for it. They also noted that organized trade in general, which includes e-commerce, tends to have better margins for them due to that more premium product mix being sold through those channels.
Interesting. And their long-term financial goals? Still aiming high.
Yes, the long-term goal remains double-digit earnings per share (EPS) growth. They see this being achieved through a combination of growth, led by volume, returning to more average levels of pricing eventually, and that operating leverage kicking in. But achieving it relies on the overall FMCG market growth improving as well.
Right, they need the market tide to rise too. Anything else stand out from the Q&A?
A couple other points. They explain why their receivable days have increased, essentially. They're taking a bit longer to collect cash from trade partners. They said this is a conscious decision to leverage their balance sheet, support distributor growth, and ultimately drive higher distribution reach. They still expect to maintain negative working capital overall and a strong cash conversion ratio.
So using their financial strength to fuel channel growth.
Exactly. They also elaborated a bit more on the Life Buoy relaunch, emphasizing the shift to include advanced skin protection alongside germ prevention is an enhancement journey that's proven successful in other regions. On toothpaste, they acknowledged the market has high promotional intensity, but said HUL's approach with Close-Up is different. They've actually increased pricing and are focusing on functional benefits like freshness and confidence, plus premiumization, rather than just competing on promotions.
Sticking to their brand strategy even in a promotional market. That takes discipline.
It does. They also made it clear that the current lower EBITDA margin outlook for the next few quarters is a specific, conscious decision made with their board, timed to coincide with the expected macro recovery and the investability of their current portfolio. It's not, they stressed, part of some broader mandate to lower margins across all emerging markets.
So a deliberate Indian strategy, not a global directive.
Precisely. And finally, they gave an update on their Oliva acquisition, the skincare clinics. They mentioned it's grown impressively from about R100 crores annual revenue run rate when acquired to around Rs 400 crores now in just over 2 years and has achieved break-even profitability. They expect further profit improvement as it scales. They also briefly touched on the detergent category dynamics, again optimizing the bar segment, ensuring profitability in powders like Surf Excel, and aggressively growing the high-potential liquid segment with brands like Surf Excel, Rin, and Sunlight, aiming to convert consumers from powders.
Wow, Oliva's growth sounds impressive. Okay, that really was a deep dive. So much information packed in there. To quickly try and recap, what are the absolute key things listeners should take away from all of this about HUL?
I think it boils down to this. HUL showed modest, steady growth in the last financial year, but the real story, the big headline, is the significant strategic shift happening under the surface. They're moving decisively towards those future core and market maker brands.
Right, that 80% future growth target from those segments.
Exactly. And to make that happen, they're making substantial investments now. This means, in the short term, their profit margins will likely be a bit lower than they have been. They're clearly prioritizing growth acceleration. They still face challenges, no doubt, especially in areas like nutrition drinks, but they seem to have clear plans to address them.
So investment now for hopefully stronger, more premium growth later. That seems to be the core message. Were there any particular things that stood out to you as maybe surprising or especially interesting?
For me, a few things. The sheer scale of that planned portfolio shift, aiming for 80% of future growth delta from those newer segments, that's really ambitious. Also, the rapid growth they're seeing in home care liquids and across their channels of the future, like e-commerce and quick commerce, is quite remarkable.
Yeah, those growth rates were high.
And honestly, the strategic rationale behind deliberately guiding for a temporarily lower margin range, that willingness to invest significantly ahead of expected recovery, it gives a fascinating insight into their confidence and their long-term thinking. Oh, and that WEF recognition for the Duma factory was definitely a standout detail, too.
It really does paint a much clearer picture, doesn't it? Not just of HUL itself, but it gives you a sense of the broader consumer landscape in India and the kind of strategic choices these major players are grappling with. So, for you, the listener, as you absorb all of this detail, here's maybe something to chew on. Given HUL's big bet on future growth, their increased investment, and the incredibly fast-changing Indian consumer market, what unexpected new competitors or maybe game-changing trends could potentially emerge and significantly alter their course over the next few years? Something beyond what was discussed today.
That's a great question. It's definitely food for thought. And of course, if you want even more detail, we encourage you to explore the investor relations section of HUL's website. You can find the full reports and transcripts there and really dig into the nuances. Thinking about the wider implications of these trends for the whole market is always worthwhile.
Absolutely. Well, thanks for joining us on this deep dive into HUL's results and strategy. Until our next exploration.